The Canadian Securities Exchange presents your go-to source for trends in junior and small cap markets. Each month, join host Anna Serin and financial expert Bruce Campbell in partnership with Stockhouse.
Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for episode 3 of The Market This Month. The markets have been on edge this month as the world continues to wake up to daily updates surrounding looming trade wars. What we've witnessed is nothing short of historic, a $10 trillion global market swing over just 10 days in April of 2025. Investors are being reminded of the darkest chapters in market history. Black Tuesday in 1929, the 2008 collapse of Lehman Brothers, the pandemic shock of 2020, and now, to that list, we add the new entry, Liberation Day. This latest market meltdown was triggered by President Donald Trump following a series of sweeping tariff announcements over the past 2 weeks. The fallout has been dramatic. Between April 2nd and April 9th, $10 trillion was wiped from the global markets as investors fled U.S. equities and most notably, U.S. Treasuries. Perhaps the most shocking signal was the mass sell-off of U.S. Treasury bills, long considered the ultimate safe haven. The sudden plunge in both treasuries and the US dollar has raised serious questions about investor confidence and global economic stability. In true Trump fashion, late on Friday, April 11th, he made a surprise announcement, a temporary suspension on tariffs on smartphones and laptop imports, 80% of which are sourced from China. This was seen as a partial lifeline to tech giants like Apple, whose supply chains have been deeply rooted in East Asia for decades. While Apple has pledged to move some of its operations back to the US, including a $500 billion investment in massive AI server facility in Texas, most of its international production remains vital to its global strategy. Thank you again for joining us for episode 3 of The Market This Month. I'm, of course, joined by my wonderful co-host, Bruce Campbell with Stonecastle Investment Management. Thank you for joining me, Bruce.
Yeah, great to be live again, right?
Well, we said we weren't going to talk about tariffs this month, but guess what we're going to do? We're going to talk about tariffs, aren't we?
We pretty much have to.
We have to talk about tariffs. All right, well, let's get into it. So obviously, it's been a crazy month. We just talked about what's happened over the past month. Tell us your thoughts on how this is going to affect the market.
I mean, obviously, it's a lot of volatility, right? I mean, we saw the tariffs announced and the market went down by 14% immediately. And then, the pause came and the markets rallied back, 12% as the time of us doing this recording. But there's still so much uncertainty as far as what's going to happen. It's a 90-day pause, In the meantime, what can happen? Can there be different tariffs? Can there be more tariffs? And that uncertainty is not what, most investors like. And so, there's going to be more volatility, unfortunately.
Well, and I think when we look at things that have happened in history that have caused these types of fluctuations in the market, usually there's some event that's happened that it's surrounding. Yeah. But this is an event that feels like it keeps happening and we never know when it's going to change. Yeah. And I think, Trump is obviously that event. So I don't even know if Trump knows what he's doing next or maybe he does have some master plan. But I think that really is, as an investor, I feel the same fear as what's going to happen next. So I feel like I'm just bracing and trying to hold on. Do you think what most investors are feeling?
Yeah, I mean, the fear of the unknown is a big one, right? And like how much bluffing and how much, art of the deal is involved here and how much of it is just kind of like out of his control. And I think most people have a feeling that there's a degree of both happening.
Yeah.
And that out of control feeling is like, well, what happens if they make a policy error and we hit a recession? What does that mean for the markets? If, they are able to keep everything, kind of in control and like all the pieces in place, then, we could have had a downturn and then perhaps, they'll have their great economic policy that they roll out and tax savings and, markets will go higher. But if they happen to miss step and they send the economy into recession, ooh, that's a whole nother thing, right?
Okay, so I want to ask you this about the tariffs because all we hear about on the news and in all the media is tariffs. But I want to ask you from an investment standpoint, how do the tariffs affect our investments? Obviously, it's going to hurt margin for certain companies on their ability to have bigger revenues and be able to grow. Is there a downside to this? Is there a potential upside to this? Once we get this all settled, is there some kind of benefit or downfall, and how does this actually affect the companies that we're choosing to invest in?
Yeah, most economists that you talk to don't feel that there's really any upside to tariffs.
Okay.
Unless you're specifically just looking at it from the U.S. tax or revenue coming in, and it's really a form of tax.
Yeah.
Now, looking at it from a company perspective, it's really kind of interesting because the companies that have been hit the hardest with all this are U.S. companies, and they're not ones. Well, some of them are affected by tariffs because they have products that are produced in some of the areas that have been tariffed.
Yeah.
But like say you're a Canadian company and you're selling into the US and you have a tariff put on you, well, that's going to have an impact on your margins potentially and how much you sell as well, because now all of a sudden your product is, whatever, set the number 10% higher because of the tariffs. Well, now you have to compete with similar products in the US that you make, and your product is now 10% higher. So do you drop your price and lower your margins?
Right.
Or do you just have a higher product because it's a better product?
Yeah.
So that's really kind of the interesting thing that's come out of this, is that there's a lot of companies that have actually outperformed, that are global companies that are not US companies. And so the market's kind of looking at this from a different perspective, in that it's actually going to hurt the US is what it's going to hurt most, because the purchasing power of the consumers, you're basically taking that away again. We saw it with inflation, and we talked about that a million times.
Yeah.
But what you're seeing is that the purchasing power of the consumer, which we know is 70% of the U.S. economy, is now going to be, affected and impacted, because they're going to have to pay this tariff on the goods that they're buying that are going to be more expensive.
Yeah.
So that's what, I think the world and investors really worry about is, do we see a recession because of the fact that purchasing power isn't as plentiful as it was?
As we talked about in the intro, we talked about companies like Apple that have a lot of their operations and have for decades in East Asia, where they manufacture a lot of their goods. Apple has committed to spending $500 billion to set up and establish themselves in manufacturing in the US. Is this good for the stock?
Yeah, I mean, they spent all this time moving away from China, and now they're being tariffed in other areas. At the end of the day, what I suspected, they're going to get some sort of breaks and ways around these tariffs. I think ultimately will end up happening. But in the meantime, there's going to be lots of volatility, and Apple's come a long way off of its high, right? But you think about consumers, everyone wants an iPhone and they want it cheap, and Apple's already come out and said, like, if we moved all of our production back to the US, the price of an iPhone is going to double.
Yeah, absolutely.
So, there's really, most people don't want to pay for that. And I mean, it's almost a necessity nowadays. Yeah. Like, there's not too many people that don't have phones. So, everyone's getting a new phone on an upgrade, and I mean, we have to pay for it. And so there's got to be a way around that. And you already saw, where they announced that they were going to do reduced tariffs or no tariffs on electronics goods as well, right?
Yeah, absolutely. And again, though, from the perspective of the investor, I would rather just Apple keep status quo.
Yeah, I mean, they've set it up to be the most efficient to get
Absolutely.
the goods, to get the goods into the countries that they need to at the best price they can and maintain their margins.
Yeah, absolutely. Okay, so speaking of all of this volatility, let's talk about volatility. So the VIX index, which is something that you look at regularly, and as we discussed last time, this is something that you can look at daily, and it gets updated throughout the day, right?
Correct. Yeah.
Okay, so we learned that last time. I saw some interesting information about the VIX. So the VIX is referred to as the fear gauge or the panic index on Wall Street. But some interesting things that we saw was that on April 7th, the VIX spiked to 60.13.
Yep.
And to give you some perspective, historically, on the Lehman Brothers crisis in 2008, it reached 59.89. And during the COVID market panic in March of 2020, it hit 53 of 54. So this has now trumped all of those big days. So tell us what's going on there and your thoughts.
Yeah, I mean, it's the uncertainty that it happened in such a dramatic fashion. And so there was a lot of portfolios that needed to be readjusted to reduce risk.
Yeah.
And when they do that, they use options. And so, the volatility of those options really spiked up. And we saw it hit a level that, it was pretty high. Like we talked, last month about it being over the 30 level being high. Well, we came into the tariff announcement on the 2nd at it already at 22. And so it was already in the middle of that like volatility band that we talked about. And then it was immediately over 30 and then, up to the 60.
Oh, it's unreal. And usually if that goes up, the market goes down is typically the relationship.
Yeah, for the most part, you don't typically have high volatility and a calm market that's, steadily moving up.
Yeah. One thing I wanted to ask you is, we talked about this in the intro as well, is just that, there was this $10 trillion swing in the market over a 10-day period.
Yeah.
When people talk about it correcting and kind of coming back to some level of or up from its lowest point there, it still is somebody or a fund manager or an investor that has sold that stock in that swing and somebody else has purchased it. So there still is a change in ownership in the equity, right?
Yeah.
So there are still people being harmed. Even if it corrects itself, there are investors that are getting harmed in this turmoil, right?
Yeah, 100%. Yeah, if you sold your stock at this level and the market, well, you say you held your stock, it dropped down to here, you sold it here, and somebody else is the new owner. Well, you've lost all of that there.
Yeah.
And somebody else, if it goes back to where it was, somebody gets that advantage, but you don't.
Absolutely.
You sold and you've lost. Right?
Absolutely. So. Do you find that, obviously as a fund manager, must be interesting times for you. Do you find that you're able to manage these waters, or do you find that you implement a different strategy?
We don't implement necessarily a wholesale different strategy, but we tend to be a little bit more sort of cautious and slow with what we do just because markets are moving so fast, and we tend to reduce our position sizing. So we did cut down our position sizing when things started to get a little bit volatile. So if we had a position in a company that was normally 2.5%, we might have 1.5 or 1.25% position of the total portfolio. And then right now, when it was so volatile during, kind of that first week, we weren't adding anything new to the portfolio. We wanted to see that volatility come down.
Right.
Once it did, after the pause was announced, there was a few things that we said, okay, that looks attractive. Let's start picking away at that opportunity.
That's impressive. Yeah. Okay. Speaking about that, one thing that we also saw as we get into, we're going to talk about gold price and the US dollar, but leading up to that, the one other thing that we saw was this fear of US T-bills. This is not something we've seen in a very long time, and shows investor sentiment of people exiting the US T-bill, which has been one of our safe havens globally, right?
Yeah.
So what does that look like?
Well, it's kind of interesting because, historically, when you've seen the stock market go down, especially the US stock market, or really globally stock markets, the US dollar typically gets bid up, and US treasuries get bid up as well because people are moving to safety, and the reserve currency of the world has been the US dollar. And the treasury bills are considered, kind of one of the safest assets that are out there, probably beyond cash. But right now you get a little higher yield with the treasuries. But what's happened is we've seen the opposite. So the stock market went down at the same time the dollar went down, and the treasuries prices went down. So the yields went up. And to me, that's telling you that foreigners are selling. And so they're selling US assets and taking them out because they're selling the stocks, they're going down. And they're taking that dollar and, selling the dollar to buy a foreign currency, and that's going down. And then the treasuries, the same thing, like the price is going down because they're selling those and, taking their dollars and moving back to their own country.
Right. And typically once they make that move, they're not jumping back into the US waters overnight necessarily. So it will have a permanent impact to it.
Yeah, it certainly could for sure.
Yeah.
A lot of that's going to probably depend on what happens now with policy going forward. So if we do see the U.S. come out with, stimulative economic policy. So if, they get this tariff thing figured out, and maybe, this is their master grand plan to get zero tariffs across the board. And at the same time, they introduce some sort of tax cuts and regulation changes, and, economy takes off, maybe people go back into the US. These tend to move in long cycles. And so it seems like people are repatriating capital to some degree right now. And I think that probably continues. You have seen, a lack of trust now in the US and kind of what they provide because of the, rapid changes in policy that can have a fairly big impact. So I think people are just like, you know what, let me take my capital back. And then I'll figure out what I want to do with it.
And see how things play out. I mean, I have watched a lot, and there is a lot of discussion of people that have been very close to his administration that have said he really does believe that tariffs are a great way to fund, the government in the U.S. So I don't know if this necessarily has an end game for it to be all, none of us know. I mean, who knows if he knows, but we will find out. And I feel like we'll be talking about it again in episode 4. So stay tuned for what he's going to do next month. Okay, let's talk about gold price. Another thing that we've been talking about since the beginning of the year. Tell us about that.
Yeah, I mean, if you look at gold, it's been one of the best investments over the last year. It's up close to 40% in the last 12 months, and year to date, it's up, around 25%, call it. And it's really been an asset where people go when they're concerned about, safety, and they want something that is going to hold its value. And that's what you've seen. They've moved into gold. You've seen some central banks move into gold as well. And so it's been, kind of the one really solid investment this year, over the last 12 months, but then also this year to date, because when you saw all the volatility within the markets around the tariffs, there was a flight into gold.
Yeah. Okay.
And it's interesting because, gold historically, it has a negative correlation to the US dollar. So meaning the direction that it's going versus the direction that the dollar is going are usually the opposite. And that has been the case. We did see gold perform when the US dollar was doing well, but now that the US dollar has rolled over and dropped, 10% off of its high, gold is just starting to accelerate again.
Which is great.
If you're a gold investor, for
if
sure.
If you're a gold investor. Yeah. Okay, so here's what I find exciting about this, and maybe I'm getting ahead of myself. You can slow me down if so, but the idea, though, is that if gold gets to these levels, and this is something that that you were mentioning, is that all of a sudden these gold projects can start becoming profitable, and that the majors might start looking at smaller projects for M&A activity. So tell us about that.
Yeah, so I mean, if you think about gold's $3,200 an ounce when we're recording this, and if you looked at kind of the lowest operating costs that a mine might have, I mean, I'm sure you can find something a little less, but like usually it's around kind of the best are around $600-700, like their all-in costs to mine the gold. But usually like the average producer is probably somewhere in the $1,200, $1,500, $1,800 range, depending on what their reserve looks like. And now at $3,200 an ounce gold, if you have $1,500 costs, you're making really solid money on that. And so what that means is that projects that probably weren't economic they wouldn't have been economic for sure at when gold was $1,000 or $1,500, now they could be economic, and even probably pushing into the $2,000 an ounce costs would be economic. And so you'll start to see these projects moving forward. But at the same time, we've talked about this before, the regulation, the costs and the timing takes so long now to build a gold mine from when you find the discovery to when you put it into production, that for the majors, it's still probably cheaper for them to go out and buy than it is to try to build a mine.
Right.
And so I suspect that if gold stays up here like it is, you'll start to see, some of those companies get picked off, especially given that, gold's had a fairly strong move, but you haven't seen the producers rise the same amount that you would have expected to where gold is. Like a lot of the mining stocks aren't back to their highs that we saw even in 2020, 2021.
Yeah.
Even though gold is hitting record highs.
Right. Well, hopefully that's what we start to see.
Yeah, I mean,
hopefully it becomes reflective, and hopefully there's a trickle down and it moves down into the exploration world.
Yep.
And just them having the ability to raise more capital and further their projects further. Usually it kind of eventually will get there. So that's that's my hope for all of them. Let's talk about, this is something that over the years that you and I have been doing this, you bring this up a lot, and I think it's something people don't necessarily think about, but you watch investor sentiment, but you also wanted to talk about business sentiment as well. So tell us about that. What's going on there?
Yeah. So, I mean, with what's happened with this sell-off, sentiment has really swung from one extreme to the other.
Yeah.
And so, a few different things that we track from a sentiment standpoint on investor sentiment is we like to track the American Association of Individual Investors, and they weekly review and interview 1,000 people and ask them if they're bullish or bearish on the market.
Yeah.
And we've actually seen net bears in that survey for the last several weeks, which
Okay.
is interesting because you don't see that very often. It's usually, in really kind of negative markets. And then the other thing that we like to look at is the American Association of not the American Association of Individual Investors, that's what I just talked about, the National Association of Active Investment Managers in the US. And each week they survey that group to see how fully invested they are. And usually they kind of sit around, in the 80 to 90%
Okay.
range in kind of normal markets.
Yeah.
And, under times of, real volatility and fluctuation, that will drop. And right now it's around 50%. If you kind of go back to, 2022 lows or COVID lows, it was kind of in that 30, 40, 50% range. And it's dropped down, kind of into that 50% range now. So that's, kind of interesting that sentiment's really pulled back on very negative really quickly. So while there's going to be lots of volatility around policy, it usually, when it gets that level, presents longer term opportunities. So if you're a, 3, 4, 5 year investor, you'll probably look back at this and say, wow, that was a fantastic opportunity for me to pick up something.
Yeah.
On the other side, looking at business sentiment, this is also, which is really interesting because the National Federation of Independent Business in the US, they survey their members. And after President Trump was elected, it had one of its biggest spike ups, fastest rate of ascent in history. There's only a few other times in history that it did that. And now it's actually come and dropped the other way.
Really?
And we've seen it, starting to drop off. And then when you look at consumer sentiment, which is, again, we talked about the consumer in the US being 70% of the economy, and that's where they could potentially be hurt by all of this. That's dropped off to the second lowest level in history. So it's the last reading before the show here it was 50.8, and it dropped down to 50 in 2022. And in 2008, it wasn't as low. And during COVID, it wasn't as low. And so it's really scared the consumer.
Yeah.
And, for all of his talk of like, this is going to help the consumer and it's going to be, all this money for workers, everyone's looking at this saying like, wow, all these goods that I buy are going to be, 10, 15, 20% higher. And that doesn't sit well with me after I've just gone through this period of inflation.
Well, I think too, there's also a lot of confusion as a consumer, right? So if I go to buy a car, if I need to buy a car right now, or if I need to buy a new computer, I'm confused as to how this will affect my purchasing power, right? Because it really is changing on a daily basis. So I appreciate that as well.
And I don't necessarily know if a lot of the consumers recognize that they're paying for it.
Right.
Like the way it's been positioned
That's right.
by, the US government is that, this tariff is something that the producer is paying, but the producer doesn't pay that. They sell into the country, and then the country slaps this tariff, which is a tax on top of it that ends up, being paid by most likely the consumer, unless,
The manufacturer doesn't necessarily
subsidizes it or the middleman subsidizes it, right?
I was reading an article that there is some government or federally funded subsidies that are being created in the UK to help subsidize. So we might also start seeing that, which is just as painful.
Yep. Yeah.
It's gonna hurt. It's gonna hurt no matter how it plays out.
Yep.
Okay, let's talk about by the time this airs and before we get to speak again, there's gonna be a really big change, and it's not either of us changing, which I know most people would be concerned about. We're gonna have a new prime minister. So we are going, or we might have the same prime minister.
Potentially. Yeah.
Right? So we're going back to the polls on April 28th.
Yeah.
So it'll be interesting to see what happens. And hopefully everyone make sure that you get out there and vote. It's really important. It's really, really important. Doesn't matter who you want to vote for, but make sure you get out there and vote. Very important. Okay, let's talk about some CSE news. It was an interesting month in the markets, but it was a fantastic month at the CSE, Bruce, which is very exciting. So the first thing I wanted to mention, which has been something that the leaders at the CSE have been working on for quite a long time, is having access to a discount brokerage platform or platform itself called Interactive Brokers. And Interactive Brokers, people might not be fully aware of this, has slowly become this powerhouse globally because they've become kind of the platform that is utilized by other brokerage firms. So in Australia, ComSec uses Interactive Brokers as their platform, and that represents 74% of retail trading on this discount platform. So it's big news for the CSE that all CSE listed securities will now be available on Interactive Brokers platform globally on all of their global platforms. It's a significantly expands access to the CSE issuers for a worldwide investor base. And this is something I think that's really important for the Canadian junior markets, is we've always had this really healthy investment from Europe and Germany and Australia and the US. We've really been supporting the junior markets from so many jurisdictions. So this is just so exciting for the CSE and CSE issuers. Thank you so much to our senior management team who pushed this across the finish line. And thank you to Interactive Brokers. So we're very excited about that. We also had some new listings, and one that I'm excited to talk to you about. We had a new listing on Friday, April 11th, SNDL Inc. And I was excited to talk to you about this one. They're making headlines this month as they join the CSE. The company is one of the largest vertically integrated cannabis businesses in the country, in Canada, and the largest private sector liquor and cannabis retailer in Canada. Its retail presence spans across major banners like Ace Liquor, Wine and Beyond, Liquor Depot, Value Buds, and Spirit Leaf. And on the cannabis side, SNDL's consumer brands, including Top Leaf, Contraband, Palmetto, Bonjack, La Plogue, and No Future, among others. Beyond retail and production, SNDL is also active in the investment front, deploying strategic capital through direct and indirect investments across North American cannabis space. We haven't talked about cannabis in a while. This is a big new player that's come to the CSE in an interesting market and in an interesting time for the cannabis space. What are your thoughts on this?
Yeah, I mean, it just gives them access to capital, right? And they have been, very acquisitive in the past.
Yeah.
Made lots of moves and lots of transactions. So yeah, it's interesting to see.
Well, and I think you hit the nail on the head, is that it really is the companies that have survived it. They're really impressive companies with great fundamentals. And now with teams that have executed, over a long period of time, this aggressive growth and in this market. So congratulations to them. We're very excited to have them with us. We had another new listing, Lithos Group, They're now listed on the CSE and making waves in the clean tech and mining with its patented Aqua technology, a sustainable method for extracting lithium and brine without added freshwater, chemicals, or evaporated ponds. We haven't talked about lithium in a while, so this is kind of exciting. I know in the junior markets, which we live in a bit of a different ecosystem than some of the bigger markets, but lithium definitely has been a darling for some time, and I know that is well loved in the space globally. And finally, I just want to mention Yukon Metals. They closed a $10 million financing. They are now financed up. I think they have over $17 million in the bank to fuel an aggressive drill campaign this season at their Star River, Arizona and Birch properties. I just thought that this was really exciting because to see some nice capital raises in the mining space, especially in this moment. It was co-led by Cormark Securities and Canaccord Genuity. These are big names, impactful names that are helping in the space. And obviously, it's in the precious metal space and in a great jurisdiction. But what are your thoughts there? Are we going to start seeing some of this money?
Well, I think you have already. I mean, here's a good example. You've seen others in that sector that have raised money, and I mean, the more returns are there on the big cap stocks, it just works its way down as people
Yeah.
are looking for, what's the next opportunity.
Yeah, absolutely. Well, congratulations to them. Their team is fantastic. So congratulations to them. Okay, Bruce, as we go into the next month, what are some things that we should be thinking about?
Really, it's going to unfortunately be all around policy in the US,
Yeah.
right? I mean, that'll be a big one is what happens and where does it go?
Yeah.
And then the second is if we get some definitive ideas of where it's going to go, then what starts to emerge? Because typically when you see a correction like this, you tend to have a leadership change. And so that will be really interesting to see if we have that leadership change,
Right.
and then what that new leadership area is going to be.
Right, absolutely. Well, it's always a pleasure to chat with you. I feel like our agenda might not be that different next month, but you never know. Thank you very much, and look forward to chatting next month.
That's great. Thanks.
Thank you.